With the average tax refund, you can buy 187,200 Tic Tacs on Amazon, 1,815 Raffaello coconut candies, see 356 movies, or pay 1.5 months of rent in Los Angeles. Hello, my friends. This is Ruben, and in today's video, I'm going to share with you how you can avoid throwing away your tax refund this year. Specifically, I'm going to talk about the average tax refund in 2022 and the 6 things that you should do when you get your tax refund. At the end of this video, I'm going to share what you need to do to stop getting tax refunds. And yeah, you heard me right. Stop getting tax refunds. They're a huge mistake. Now, before we get into the video, please click that like button and subscribe. We're almost at 30 subscribers. That's fantastic. According to the most recent 2022 filing season statistics, the average tax refund is $3,263. Recent surveys suggest that 1 in 3 Americans will spend that money immediately, whereas 1 in 2 Americans will spend that money within 3 to 6 months. Here are the 6 things that you should do with your tax refund. Number 1, this is going to be the most controversial opinion on this channel. There's a general consensus out there that whenever you receive a tax refund, you should take a portion of that money and spend it on yourself. I don't buy it. All that's doing is rewarding a bad habit. And at the end of this video, I'll explain why it's a bad habit. Avoid all temptation to spend any portion of this tax refund on any immediate gratification purchases. Instead, consider taking $25 and donating it to a charity of your choice. To you, you won't notice it at all. However, it can go a long way for somebody else. Number 2, if you don't have an emergency fund, set aside $500 into a high yield savings account like Ally or Alliant. Remember, only use your emergency fund for emergencies. And to determine if an event is an emergency, you have to answer yes to 2 out of 3 questions. First, is it unexpected? Second, is it urgent? And third, is it necessary? Number 3, pay off high interest debt. These are your credit cards, payday loans, and personal loans. Coming from experience, whenever you get the chance to pay these off, pay them off and don't get back into this kind of debt again. Number 4, contribute to your retirement accounts. And remember, the order is this. First, you contribute to your employer's 401k up to the match. Then you max out your Roth IRA. And if you're married, max out your spouse's Roth IRA as well. Then if you're eligible, max out your HSA, and if you're married, max out your family's HSA as well. Then you go back to your company's 401k and you max that out. After that, you can contribute to taxable brokerage accounts. And look, if you've done 1 through 3 already and you still have money left over and you don't have a retirement account, open up a Roth IRA at Fidelity or Vanguard and contribute to that account today. Number 5, contribute to long-term savings. The reason you should start contributing to long-term savings versus short-term savings is because it will kickstart the intention to start saving for items related to delayed gratification. It is an important life lesson to know that you can afford the things that you want in your life through intentional planning and saving. Examples of long-term savings goals include saving up for a down payment on a house, going to college for the first time, or going back to school, and even paying off low-interest debt like student loans and mortgages. Number 6, contribute to short-term savings. Generally, a goal is considered to be short-term when it occurs within 3 years. Examples of short-term goals are paying off your car, going on vacation, or proposing to your significant other. The likelihood of anyone going through all 6 of these steps and having money left over is pretty much nil. However, do not split these steps up. Remember, do them in full. So start at the top with $25, then the $500, then the high interest debt, and so on. Now the moment you've all been waiting for, the whole reason why getting a tax refund is a huge mistake. And the key word here is refund. The only time you've ever gotten a refund is if you've overspent. The reason that you got a refund from the IRS is because you were withholding too much federal income taxes on your pay stubs. You're paying the federal government too much money in income taxes every time you got paid. At the end of the year, you file your tax return and the IRS goes back and says, oops, looks like you paid us too much in taxes. You know what? Here's a check for $3,263. Sorry about that. Excuse me, you know what just happened? You just gave the IRS a $3,263 interest-free loan. The IRS made money off of you just by holding that money in a bank account. If that still doesn't rock your boat, think of it this way. The S&P 500 in 2021 returned an astonishing 26.89%. This means that if you took that $3,263 and invested it in the beginning of the year, you'd have returned an approximately $4,140. That's almost a $900 increase that you're missing out on. Do not make the mistake of missing out on this money next year. Instead, call your human resources department and tell them that you want to update your federal income tax withholding or your W-4 form. And look, if you're not sure what to update your W form to, check out the free tax withholding estimator tool on the irs.gov website. I'll link it in the description below. Look, it's gonna take you about an hour to do, but honestly, for $900, that sounds like a great hour spent. It's important to know that once you do correct your W-4, the next step is to actually use that money appropriately. So remember, if you change your W-4 and do nothing with it, you won't reap the rewards. So instead, consider investing that money or paying off any high interest debt. Comment below the smartest and dumbest thing that you did with a tax refund. I'll share mine too. And if you've enjoyed this video, please click that like button and subscribe. We're almost at 30 subscribers and it means a whole bunch. And as always, thanks for watching. See you tomorrow. Hey, you just watched a video. Why don't you check out this one right here? Or you know what, even this one right here. They're both pretty great. Thanks for watching.